For the past few years, it's felt like a handful of giant companies have been the entire stock market, right? But something is definitely changing. We're seeing the first real signs of a massive shift, what some are calling the Great Rotation of Capital, and it could totally redefine the investment map for 2026 and beyond.
And that brings us to the big question on everyone's mind, the one we're going to tackle today. After years of just absolute dominance, is big tech's reign finally actually coming to an end?
All right, so let's get into it. To really understand where we might be heading, we've got to first appreciate where we've just been. For what feels like forever now, the market has been marching to the beat of a very, very small but very powerful drum.
I mean, just look at this number. It is absolutely staggering. In the middle of 2023, 99% of the S&P 500's entire return was driven by just 7 companies. You know them, the Magnificent Seven. Just let that sink in for a second. The performance of the other 493 major U.S. companies was basically a rounding error. That's a level of concentration that is just wild.
And you know what? We've seen this movie before. Analysts, like the ones at Lyrical Asset Management, point out that this kind of crazy performance gap has only happened one other time, right at the peak of the 90s tech bubble. And here's the kicker, it was fueled more by investor hype driving up stock prices, what they call multiple expansion, not necessarily by a huge surge in actual profits. And that, my friends, is often a classic sign that a trend is getting pretty stretched.
But then, that concentration started to crack. In the final months of 2025, the whole script began to flip. For the first time in a long time, the giants actually started to stumble, and the rest of the market didn't go down with them.
And you can see that divergence right here. As people started asking tougher questions about things like AI valuations, the Magnificent Seven actually posted negative returns in November and December, but the broader S&P 500, well, it just kept right on climbing. This was the first really clear signal that leadership in the market was starting to broaden out.
This chart tells the story perfectly. See, the normal S&P 500 is cap-weighted, which is just a fancy way of saying that giants like Apple and Microsoft have a huge influence on it. That index was up just 1%. But then you look at the equal-weighted version where every company, big or small, gets the exact same vote. It was up 5%. This proves that the average stock was actually doing way better. The rally was finally spreading beyond just the big guys.
So, if the biggest, most crowded trade of the last few years is starting to unwind, you gotta ask, where's all that money going? Let's take a look at what the new investment map for 2026 is starting to look like.
From what analysts are saying, there seem to be 3 major areas that were pretty much ignored during the whole tech frenzy. These are the corners of the market that are now getting some serious attention from investors who are hunting for value and, well, some diversification.
Okay, first up, smaller companies. After 9 straight years of getting left in the dust by their bigger peers, small and mid-sized stocks are now trading at a massive discount. We're talking a 22% valuation gap, which is near a historic low. A lot of analysts are seeing this and thinking there's a huge runway for these companies to catch up, especially if the economy holds up.
Next on the list, the return of value stocks. You know, these are the solid, maybe less flashy companies that are considered cheap compared to their earnings. The price gap between these value stocks and the expensive growth stocks had stretched to a truly historic extreme. And while it's narrowed a tiny bit, that gap is still massive. It suggests that things could snap back, and these fundamentally grounded companies could have their day in the sun.
And finally, investors are starting to look abroad again. Get this. International stocks now make up one of their smallest slices of the global market pie in 4 decades. 40 years. With the dollar getting a bit weaker and other economies pumping in stimulus, many are seeing a really compelling long-term case for rebalancing and adding more global exposure.
Okay, so the map is changing, the leadership is broadening out. What does this actually mean for you trying to navigate the markets in 2026? How do you adapt your strategy for this completely new reality?
Well, this new environment probably requires a different kind of playbook. First, embrace diversification. Seriously, the era of just betting on a few winners might be over. Second, focus on quality. We're talking companies with strong finances that can handle some bumps in the road. Third, stay disciplined. Don't go chasing whatever the hot trend of the month is. And finally, manage your risk. Just accept that with more stocks in the game, things might get a little more volatile.
Look, if you only take one single thing away from this entire explainer, please let it be this. For the first time in years, the most important word in investing isn't concentration anymore, it's diversification. Spreading your bets isn't just a defensive move now, it's quickly becoming the main offensive strategy.
So we've seen the evidence. The market is going through a really fundamental shift, moving away from that extreme concentration we've all gotten so used to. The great rotation really does seem to be underway. And that leaves us with one final crucial question to think about. The market is changing. Is your portfolio